What's up guys, it's Flash. In this video, you're going to be getting tips and tricks of a Wall Street veteran, David, from the Best Stock Strategy. He's going to be going over his whole journey in options and going to be giving you some free insight of what it's like to trade options. If you're interested, you want to stay tuned, it's going to be a video for you. Before we get into the video guys, if you would please do me the honor and please smash that like button, and if you haven't already, hit the subscribe. Hope you enjoy. God bless. Making $100,000. Characters I met along the way that stepped in and are a big part of my story. There, so stay tuned. And I heard of these terms. Now, I don't understand them, so I'm just asking as a question. And people out there looking to get into options, maybe you can advise them on what these are. It's like you always hear, oh, the beta or the data on that particular stock and stuff like that. These are terms that go around. Like, to me, what an option is you buy it, let's say at 150, and you want a strike price of 190, we'd say, for example. Well, the closer it gets to that, the more the worth. Is that right?
Yeah, exactly. You would, and what you're referring to is buying a call option. I tend not to buy options, and the reason is that each option is like an insurance policy. So on your car, you have to buy insurance and it has an expiration date. So the insurance company makes money, the insurance company gets rich. But when you sell options, you're actually acting like the insurance company. And the reason is that there's a time element to the option where every day that you hold the option is worth less. So that's the reason why I choose to sell options, because in the example that I gave before, if Apple falls to $145 and you agree to buy it at 140, so let's say Apple is trading at 155 and it falls all the way to 145. If you agree to buy it at 140, you can still make 100% of the profit. You can keep that premium that you received even though Apple fell $10. So meaning that, let's say you were driving your car and you had collision insurance, right? And then let's say your son's friend dinged the door, so you had like a scratch in the car. If that's not covered under the insurance policy would not have to pay out any claim. Meaning that when you sell options, you can still be wrong directionally. Now, going back to that example, I could sell a 140 strike, is what they call it. I can agree to buy Apple at 140, and Apple can fall from 155 to 145, and I can still keep all of that profit. Whereas if you buy options, if the price goes against you, then you wouldn't actually make money.
So, what you're doing, putting puts on options, is that right?
Yeah, I sell puts and I sell calls. So
no, when you say you sell them, this is where I'm getting this is where I think I'm losing you here. So you sell them.
So when someone buys them, then they're buying them from someone who's selling them. When I sell a put, that means that I agree to purchase or agree to buy at a specific price. So if Apple is trading at 155. If I sell a put with a strike price at a price of 140, that means that I agree to purchase Apple. And someone would buy at 140. Someone would buy that because they would think that let's say they have a lot of gains in Apple and they want to lock in their gains. So they're scared that maybe the economy or the stock market is too volatile. They would buy a 140 put, which means that if Apple fell to 120, I would be forced to buy it from that person at 140.
Okay.
And then on the call side, if I agree to sell a call at a specific strike price, that means that I would agree to sell that stock at that price. So for example, when Facebook was trading at like $218. If I sold a call option at a price of 220, I want the stock to go down because that means that I can keep the premium, and as long as Facebook stays below 220, then I'm able to keep all that money. So pretty much, just to summarize, when you sell a put, you want the stock to stay above that specific strike price. So if you sell a put on Apple at 140, you want it to stay above 140. If you sell a call on, let's say, Facebook when it was trading at like 218, let's say you sold a 220 call, you want the underlying stock, so in this case, Facebook, to trade below 220. So you're just putting like guideposts on the stock. You're bracketing the stock and saying, I think it's going to stay between these two prices, the upper bound in which you would sell a call and the lower bound in which case you would sell a put.
Okay, no, I think you nailed it with the example and the explanation of what exactly they are and what exactly you do. So guys, I hope you enjoyed that video. If you are interested in seeing the full interview, I have put a link in the description below. Go check it out. The full interview is there. If you are also interested in getting in contact with David and maybe looking to educate yourself in options, there is a link and a discount code for his course down below, so go check it out. God bless.